Now, Baird called the drop, quote, excessive, and upgraded Zions from a neutral to an outperform today, saying the panic selling provides a great buying opportunity. Joining us now, the analyst behind that call, David George, covers U.S. banks at Baird. David, why are you confident that the worst, hopefully, or maybe behind Zions?
Well, good afternoon, Brian. I think from my perspective, it's important. Questions like these, I think, require a lot of context. And again, as you said, Zions yesterday lost over $1 billion in market cap over a $50 million fraud. And we're certainly not here this afternoon to minimize that fraud. But again, in the context of losing $1 billion in cap, and keep in mind, Zions has a very consistent long-term track record of keeping credit costs low. In fact, the average over the last 10 years, Brian, only 12 basis points of losses. That means they're right 99.9% of the time. So to be able to buy the stock at just under tangible book value, 7.5 times earnings, we think is an asymmetric risk-reward opportunity to the upside. We think this is a $60 stock in the next year or so.
Wow. I guess the fear and the word cockroach has been kind of thrown out there. I think it was Jamie Dimon that might have said it. Either way, basically the idea that if there's a couple bad loans from these bankrupt auto parts companies, that there might be more bad loans just sitting out there like a cockroach. You see one or two, you probably have 20. Sorry for people that don't like cockroaches. You get the point. Doesn't sound like you're worried that this would be a contagion, David.
Well, again, we're always focused on credit quality. It is clearly the most meaningful risk facing banks and bank investors broadly. But again, it's really a contextual question. We are at cyclical lows as it relates to credit costs and bad loans. So it is reasonable to expect that bad loans will go up and credit costs will go up. But again, the industry is very well reserved, very well capitalized. And I think it's important for market participants and your viewers to keep in mind, bank loans have only grown at 2 to 2.5% since COVID. So this is not like the 2005 period when we were covering these stocks and we saw a number of banks growing construction loans 15 to 20%. Again, we're talking about 2% growth. So it's not clear to us that there's any meaningful bubbles on bank balance sheets today.
I think the fear, and again, we're speaking broadly, David, but
Sure.
I maybe, and if you agree, tell me. If you don't, tell me. That the worry is that this kind of came out of nowhere. Is a company, First Brands, that nobody had ever heard of, if they weren't in the auto parts business, or Tricolor, again, specific companies. They're bigger than we thought. They've got these loans. Some of these financial institutions got hit for a couple days. And there's just a nervousness out there because this kind of came out of nowhere.
Yeah, I think that's fair. I think that's right. These were big numbers, and they were surprises. But again, and this is the kind of thing, Brian, that you see late in an economic cycle. The incidence of fraud tends to pick up.
Boom.
So it's not particularly surprising to see fraud, but these, to your point, these are big numbers. But again, in the context of the amount of market cap that's been taken out of the sector just this week, we think that it's very excessive.